So in today's video, I'm going over a question I get asked all the time. And that is what credit repair moves I should focus on, and specifically, what credit repair steps should I be making based on my credit score stage. And I'm going to be sure to go over my top repair recommendations for each score category in 2026. Now for our new viewers out there, hi, my name is John of John's Finance Tips. I'm the guy who's helped break down well over hundreds of credit profiles and millions more of points in interest that people didn't have to pay. The only thing you have to do is tap that little thumb icon. Now, having been in the credit and credit repair game for close to a decade now, I can certainly recognize that everyone's situation is going to be different. Some of you are going to be further along, while others are going to be further behind. But just use this video as a guide relative to where you are on your credit repair journey. However, regardless of where you are on your journey, the most important thing to do when it comes to fixing your credit is paying on time and keeping your balances low. And as a quick reminder for everybody, your credit score, which is the number that could save you tens, maybe hundreds of thousands of dollars in unnecessary interest payments, is affected by 5 key components. And the 2 most important are on-time payments, which account for 35% of your score, and credit utilization, which accounts for 30%. Those 2 added together is 65% of your score. Therefore, that's why I always say, if you want to fix this thing the right way, please make sure you are paying on time and reporting low balances. The video is going to break down as so. First, we'll talk about the score bracket. Then we'll talk about the types of repair moves you should see in there. Then the cost, followed by the number of moves I expect you to focus on there. And of course, the ultimate goal in that particular bracket. If you have any questions, feel free to comment down below. And if you want to support my channel, feel free to check out any of my affiliate links in the description box. The first score bracket is under 580. Technically, if you're under 580, you shouldn't be thinking about fancy optimization. So this is actually more applicable to someone who is dealing with real damage and needs to stabilize the file first. Because in an under 580 profile, one of the easiest safe ways for you to start getting momentum and the type of move you can make is getting added as an authorized user to someone who has a strong card. Honestly folks, this is really how some people start a weak profile. Little Johnny turns 18 and already has a 700 credit score. How is that possible? That's because Little Johnny's parents added him as an authorized user when he was 15 or 13, and he was able to inherit some of his parents' good credit history, and therefore when he was going to apply for his individual cards, he already had a really strong profile. Same idea here. If your score is crushed and you have someone close to you with a well-managed, aged card, being added can sometimes help your utilization and age of accounts. I do want to caution and say, if you add someone as an authorized user, they are 100% not responsible for the debt. Meaning, you give them the card and they go charge off $10,000. They never have to pay it back because it flows to you and you're going to be responsible. So my recommendation is, if you're adding someone as an authorized user and you're not confident that they fully know how to manage your credit card, just take the card and put it in a sock drawer, because they will still inherit some of your good credit profile. The other thing to note is, not every authorized user account is going to help equally. For example, a maxed out card or a brand new card is not what you want. But a card with low utilization, perfect history, and a decent age can be helpful. Next up, we have cost. Now for authorized user strategies, that's not really as applicable if a parent, spouse, or trusted family member is adding you. But if someone online is trying to charge you hundreds of dollars for a random trade line, run, don't walk. Next up, we have number of moves I'd see at this point. One strong authorized user account is good enough. I'd recommend trying to get the best account, meaning an account with very low utilization. Typically that would mean a card with a higher limit and a clean history. That would probably help the most. But you really don't need to go above and beyond to pile on multiple authorized user accounts. Because even though there's a benefit to being added as an authorized user, it doesn't necessarily scale linearly the more that are added on. And finally, goals. What exactly should you be doing if you are the recipient of the account, meaning you're under 580? Your goal really here is to start figuring out how exactly credit reporting works. Now, I was fortunate enough in which my parents added me as an authorized user, and they drilled it into my head that we pay our credit cards 100%. Now, they didn't explain to me why. It was just, you spend the money, you have to pay us. And so at a very early age, maybe 17, 18 or so, I kind of knew, okay, if I use this thing, I gotta pay it back. And so I would say, if you are someone giving someone an account to be an authorized user, start teaching them how they can efficiently manage a strong credit profile. And if you're the one with weak credit, take it as a learning experience. The second bracket, 580 to 640. Congratulations, you might have just started cleaning things up, or you are finally getting serious about fixing your score. Regardless though, the common theme that unites both of these folks is the fact that you're probably still pretty bruised. Maybe your report is thin, maybe it's damaged, maybe both. But you're thinking, well, if I just open a bunch of new accounts or dispute everything in sight, that should fix it. Yeah, I'm gonna pause you right there. No, remember, a rebuilding account, you must pay on time and keep low. And in this score group, it is the most important time to not rack up any unnecessary debt or any new late payments. So the two types of moves you're going to be looking at are either secured credit cards or credit builder loans. Assuming that you weren't fortunate enough to be added as an authorized user to someone with a strong credit profile. Secured credit cards and credit builder loans all look to benefit those with a very limited or damaged profile, because pretty much they exist to help you rebuild. First, let's talk about a secured credit card. This is a type of credit card in which you put down some sort of deposit and the credit limit you are given is equal to the deposit. So let's say you put down a 200 deposit. Well, now you have a credit limit of 200 and you can use the credit limit, spend it, pay it off, spend it, pay it off, and if at any time you cancel the card, you will get your deposit back. In addition, if at any time you graduate from a secured card to an unsecured card, you will get your deposit back, but you will still have an available credit limit. The thinking here is, we don't know if we can trust you. So you give us your money, we'll hold on to it. You show us you're responsible when paying it back off. At some point, we'll give you back your money and extend you credit. One card I would take a look at in this segment is a quality no annual fee secured card. Now, typically secured credit cards come with no bells and whistles. But the good ones do at least report to all three bureaus, and sometimes they'll review you for graduation. What I really love about a solid secured card is that after several months of on-time payments, they may start automatically looking at your profile to see, hey, can we graduate you from this secured card, give you your deposit back, and give you an unsecured card? Now let's talk about credit builder loans. Very similar to secured cards in that they're looking to benefit those with a small or damaged credit profile. The difference being, instead of revolving credit, you're building an installment account. For the most part, there's not a whole ton of bells and whistles, other than the fact that it adds another positive type of payment history to your report. The annual fee for folks in this bracket looking at this type of moves is $0 or as close to zero as possible. If you're looking at a secured card that has some sort of fee or annual fee, run, don't walk. That is a predatory card. And I haven't seen many good rebuild products that justify junk fees. Again, you should not be paying stupid fees at this level. Number of moves in this score bracket, 1 is probably going to be enough. Maybe 2, but the focus for a lot of folks, especially if you're still paying off old debt, it's not opening a bunch of stuff, it's figuring this stuff out. The other thing is, you're probably already dealing with enough. And so I would say, getting a bunch of accounts to juggle them probably isn't the most efficient use of your time. The goals in this score bracket, getting comfortable with how credit rebuilding works inside and out. Do you understand your statement close date? Do you understand your due date? Are you paying everything on time? Do you understand the fact that if you carry a big balance, you are hurting the exact score you're trying to fix? That's it. You are learning. This is really step 1 of the credit repair game. But for right now, the most important focus is making sure you understand how exactly all this credit stuff works before we pile on more bells and whistles. That's what this segment is. This is boring. This is dull. There shouldn't be anything that's really enticing you to do something you wouldn't do. Namely, oh, I get a bunch of accounts, I get a quick score bump, I get approved overnight. Like, that's a bit much for a lot of people. And it's kind of a slippery slope. Regardless, focus on learning and educating yourself as we get ready for the next category. The next score bracket we have is 641 to 700. Here, if you were rebuilding properly, you likely are getting your first real results. If you didn't have a huge mess to begin with, you likely are climbing up the score ladder. Regardless, the common thread here for both groups is the fact that you're starting to make some more serious progress, and your report is going to start reflecting that. So broadly, there are 2 types of repair moves I see for people in this category. One are what I would term my beginner cleanup moves, and the second are the mid-tier optimization moves. So let's first cover the beginner tier of repair moves. So in the beginner category, I would look at moves with slightly higher upside and with better point-for-point results. One of my favorite beginner cleanup moves is the Goodwill Letter. So this move currently has some very solid potential after you've shown months of clean history. And this is where I started to pick up some of my repair habits, where I started thinking, wait a minute, if I just get 1 or 2 late payments removed, and I'm already paying on time now, then I'm not just improving my score, I'm also improving how lenders see me. Another solid beginner move in this category is the utilization reset. This is a phenomenal balance strategy. What's beautiful about this move is the fact that for your highest balance cards, every single month, you can pay them down before the statement date and immediately start reducing the damage from utilization. So let's say the highest stress you have every month is a max out card because you've been carrying balances. Well, just target that card first, get it under 30%, and you're going to start seeing real improvement. Or let's say you have a couple cards reporting high. Great. Only use a tight utilization plan for those cards and you're going to get that score benefit faster. The other category of moves here are the mid-tier optimization moves. Now, even though I call them optimization moves, I would say you don't have to necessarily have perfect credit to get value from them. I think the industry just doesn't talk about them enough because people are too busy chasing shortcuts. but regular rebuilders can stand to benefit as well. And really thinking about where people are, you just got some traction. Maybe you want to qualify for better cards, you've got a little more breathing room, you want to clean up the remaining weak spots. This is the perfect time to start using moves like credit limit increase requests and targeted disputes for actual reporting errors. So 2 moves I would take a look at. The first is requesting a credit limit increase on an account you've managed well. This is one of my favorite mid-tier strategies because if you can increase the limit without a hard pull, you can lower your utilization without paying every single dollar down overnight. Another move you could take a look at is disputing specific inaccurate items, not random disputes, not everything, actual wrong balances, wrong dates, duplicate collections, or inaccurate late payments. You see, both of these moves can be used for credit repair. However, the limit increase strategy is phenomenal for someone who has high utilization, and the dispute strategy is phenomenal for someone who still has errors weighing the file down. And because in the 580 to 640 bracket, you figured out how rebuilding works, you are really now starting to master how to optimize for different score factors across various different accounts. So the cost that you should be expecting to pay here is going to range from $0 to maybe the cost of certified mail, and not more than that. And I'm sure some of you would have picked up the fact that a few people out there want to charge hundreds or thousands for these same moves. Don't do that. Again, here is where we can start really thinking about how we want to optimize for our overall credit repair strategy. So the number of moves I would expect someone to have in this score bracket is going to be 2 to 3, not counting the ones you've had before, but 2 to 3, whether it be goodwill letters, utilization fixes, limit increase requests, or targeted disputes. Now let's talk about the goals for this segment. In this score category, start really thinking about where you want your credit to take you. Because to get the most value out of a better score, it is going to be in the approval and interest rate category. Of course though, if you're not going for a mortgage right away, then maybe thinking about preparing for better cards, lower auto rates, or cleaner approvals. How can I optimize my various score factors? Okay, I've got something that's going to cover me for utilization. Maybe I use a goodwill letter for one late payment. Maybe I add a limit increase request for a breathing room. Maybe I clean up one inaccurate collection. Whatever it is, start thinking about how I can really start optimizing all the different categories across all of my accounts. In addition to the fact that, how can I start taking some of these small wins, right? These 20 point, 30 point, 50 point improvements, and start turning them into better approvals. The next score bracket we have is going to cover the rest, which is going to be 701 and over. At this point, you're likely getting into a strong profile or a loan ready profile. The score is going up, but you've got other things going on in life. You're likely applying for better products, you've got more financial options, and for me, this is when I really started thinking hard about how my credit score would impact my mortgage rates. Nevertheless, the type of moves I would be looking at in this category is going to be 1. Premium optimization, and 2. Loan-specific prep. And one of my favorite premium optimization moves in the marketplace is AZIO, all 0 except 1. This move has one of the strongest short-term scoring effects for people who already have a solid profile. The benefit to call out is the fact that it can help squeeze out some extra points right before an important application. Because if I think about how lenders like to see a file, they like to see very low reported balances, clean recent history, and no signs that you're overextended. Another workhorse move in the premium optimization category is pre-application cleanup. Now this move is not for everyone. However, it is good for the 30 to 90 days before a major loan. If you are in some way or category that requires a lot of precision, I'm looking at you home buyers, the pre-application cleanup is going to give you a ton of benefits. For everyone else though, I would say keep it simple, keep it clean, and don't mess with a good score just because you're bored. And as for loan-specific prep, remember, for the past couple years you've been really optimizing and thinking about how you want your score to work for you. Do you want a better mortgage rate, a lower auto payment, or cleaner underwriting? So in this score category, I have no problem looking at moves like slowing down new applications, removing lingering errors before underwriting, and making sure balances report exactly where you want them. One of my favorite loan-specific strategies is simply not opening a bunch of new accounts right before you need financing. Here's what I mean by that. Next year, if you're trying to buy a house, instead of applying for 3 new credit cards and giving the underwriter something to question, you could spend that same period keeping inquiries low, keeping balances low, and letting the profile look boring. That is insane value. Another example, instead of paying an unnecessary higher mortgage rate because your balances were too high the month they pulled your report, you could pay those balances down, let them report low, and save yourself thousands. And again, this is something you'll know because you spent the last couple years trying to figure out, hey, how do I want my credit to serve me? Maybe I read some lending guidelines. Maybe I know I want to buy a home. I'm going to make this particular move because it's going to give me this particular result. So the cost that you should expect to pay for most of these moves are going to be anywhere from basically free to the cost of your reports, or maybe certified mail. I know it's kind of crazy. The reason I love strong score maintenance partly is because it effectively pays you back through better approvals and lower rates. Whereas you look at bad credit habits, they cost you month after month after month. And for the upkeep moves, they largely come in at little to no cost. But again, doing a few boring things right and getting a better approval or a lower rate to me is 100% worth it. The number of moves in this category, truthfully, it's as many as you need. Now I did mention that this is the point where a lot of people start thinking about mortgages and cars. And so for me, a couple months before closing on a loan, I actually made sure I was not applying or getting any unnecessary credit. Because banks don't like that you're getting new credit if you are going for a loan. So keep that in mind. When do you think you're going to be buying a house or buying a car? Because you want to slow down some of your activity before that. And then once you buy it, great, you can go back to optimizing. Of course though, you want to be cognizant of that. Not that it's the end of the world, but it's certainly not going to help you from a mortgage perspective if you're opening up a bunch of accounts right in the period in which you got pre-approved and before you close on your loan. And last point is, what's the goal in this category? Well, as you can see, 701 plus is literally the rest of your life. The goal here is just kick back and maintain it. Take the time to learn how the game works. Take the time to get the optimal score factors. Take the time to keep your file clean. But really, the goal here is just enjoy the strong credit. I want to take a moment here and share with you a great shift that changed my perception on credit scores. So, I've had very strong credit for years. And I've not so much been obsessed with it because life happens, but I certainly have been reluctant to let it work for me. Because the thinking is, oh man, if I apply for something or use my profile, maybe I'll lose points. Part of me also is, well, every single year I should probably just keep it perfect, right? But for me at this category, it is build it and actually use it when it makes sense. To give you an example, if you can use that strong score to get a better mortgage rate, a better auto loan, or a cleaner approval for a business card, do it. That's really just to drive home the fact that build the score, use it when it makes sense, don't sabotage it, and don't obsess over it so much that you never benefit from it. Awesome. Well, hey folks, thank you so much for joining me on this incredible video. I hope you took something out of it, but I would love to hear people's comments and feedback down below. Do these score brackets kind of make sense? Now earlier I did say, depending on if you're earlier or later, just kind of shift it to where you are in your credit repair journey. Do you have more moves in a particular score bracket? Do you have less moves in a particular score bracket? Do you have no repair strategy at all? And as always though, I will catch you all next week.